Hello, my name is Muhammad Faizal Hakim bin Safarun. Today I want to introduce you with Ion Company. Ion is a retail and financial service company that began in Japan and expand their operation worldwide. In Malaysia, Ion was invited by the government to modernize the retail industry. Over the years, Ion has become a household name, offering supermarkets, discount store, convenience store, and malls. However, despite its reputations, Ion market cap as of January 3, 2025 is 100.825 million ringgit, a significant decrease of 89.37% in just 1 year. This drastic change underscores the need for an financial review to identify what workings and what's not. Before we go to the financial performance of Ion, we need to understand why ratios are important in business. Firstly, ratio help to analyze financial performance by assessing key areas like profitability, liquidity, solvency, and efficiency. They provide a clear picture of a company's strength and weakness beyond raw financial numbers. Secondly, ratio enable benchmarking by comparing a company's performance with industry average, competitor, or its own historical data. For example, if a company inventory turnover ratio is lower than their competitor, it may indicate inefficiency in managing their stock. Thirdly, ratio are available for trend analysis. By tracking ratio over time, business can identify patterns such as improving profit margins or declining liquidity and take corrective action accordingly. In summary, financial ratios are not just numbers, they are vital decision-making tools that guide businesses in maintaining stability, improving performance, and staying competitive. That's all from me.
Assalamualaikum and good evening. My name is Asnurina Nadira binti Abdul Manan. My ID number is PDL 2401008. Today, we will discuss about historical analysis. First is liquidity ratio. Liquidity ratio is the ability to make payment. It shows the ability to pay short-term obligation by using short-term asset. For example, to pay its current liabilities using current asset. Second is asset management ratio. Asset management ratio is to measure how effectively a company uses its asset to generate revenue or manage its operations. This ratio provides insight into how well a company is utilizing its resources to achieve efficiency and profitability. Third is debt management ratio. Debt management ratio are financial metrics used to assess a company's ability to manage and repay its debt obligation. This ratio provides insight into a company's financial leverage, stability, and risk associated with its use of borrower funds. Lastly is profitability ratio. Profitability ratio is a financial metric used to evaluate a company's ability to generate profit relative to its revenue, assets, equity, and other financial resources. This ratio helps stakeholders assess how efficiently a company is converting its resources into profit and whether it is financially healthy. For your information, under liquidity ratio have current ratio. Current ratio is a financial metric used to assess a company's ability to pay its short-term liabilities with its short-term assets. The current ratio of Ion is 0.51, meaning that the company has RM 0.51 in current asset for every RM 1 ringgit in current liabilities. Second is quick ratio. Quick ratio, also known as the acid test ratio, is a more stricter measure of a company's liquidity than the current ratio. It includes inventory from current asset, as inventory might not be easily converted to cash in the short term. The quick ratio of Ion is 0.08, meaning the company has RM 0.08 in current asset for every RM 1 ringgit in current liabilities, including inventory. Next is the debt ratio. The debt ratio of Ion is 0.64, means that 64% of the company asset are financed by debt. Under asset management is inventory turnover ratio. Inventory turnover ratio is measures how many times a company's inventory is sold and replaced over a period, typically a year. It is an indicator of how effectively a company manages its inventory and how quickly it sells goods. The inventory turnover ratio of AEON is 4.31, mean that the company sells and replaces its inventory approximately 4.31 times per year. Under profitability have net profit margin. Net profit margin show the percentage of revenue left after all expenses, tax and interest have been deducted from total sales. It indicates how much profit a company generates from its revenue. The company AEON earned 0.03% profit from its total sales after covering all expenses. Lastly is the return on equity. Measure the return generated on shareholder equity. It shows how effectively management is using a company's equity capital to generate profit. The company AEON generates 6% profit for every ringgit of equity invested by shareholders.
Okay, Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Arif bin Zaifa Azhar. So today I want to explain ratios between the industry average and then AEON, who's better. So first we go to current ratio. So current ratio, the industry average is better than AEON because they can cover short-term debt easily. But AEON cannot because maybe they have a trouble paying short-term bills. Okay, so the second is quick ratio. So quick ratio, industry average is better than AEON because AEON doesn't have enough asset to comfortable their own payoff. So next, inventory turnover. So industry average is better than AEON because industry average is good efficiency at selling good and then good at restocking inventory. So such as they have a nice technology to restocking inventory, and then they have a good agent and nice productivity to selling goods. Meanwhile, AEON who have a lower ratio mean it take longer to sell their product. Next, debt ratio. In debt ratio, AEON is better than industry average because AEON use less debt compared to industry average. So this make AEON less risky in financing. Next is net profit margin. So the industry average is better than AEON because industry average make more profit from its revenue. Meanwhile, AEON has low margin, so it is has profitable. They didn't have a good selling good compared to industry average. Okay, so lastly, return on equity. So return on equity, the industry average is better than AEON because they much better that in providing return to shareholder. Meanwhile, AEON is very low, meaning it never have better providing return to shareholder.
Hi, my name is Nurul Alisa Emlyn binti Muhammad Reza Azrai. My ID number is PDL 2401016. Refer for task 3, I would like to explain about strengths, weakness and 5 suggestions. Firstly, for strengths, based on the table competitive that I found, AEON's biggest strength is its low debt ratio of 42%, significantly lower than the industry average of 75.3%. It means AEON is less reliant on borrowed funds, reducing financial risk and ensuring stability during market volatility such as recession or rising interest rate. This financial stability allows AEON to invest more in growth operation, making it better than its competitors. The weakness in industry company and AEON's company is both current ratio and quick ratio remain at 0.5 and 0.0 respectively, implying that in the future the company face reserve short-term funding pressure and payments delay. So, for the inventory turnover remains below the industry average of 7.5 at just 4.21, indicating clear waste and higher expenses on inventory due to potential return on unsold product. So next, for the net profit margin is only 3%, half the industry average of 6.16%, underlining incompetence in operation of profitability. So next is 5 suggestions for Aeon to improve their company more better. First is improve liquidity management. Aeon should renegotiate payments terms with suppliers to reduce short-term cash flow pressure. It should also create cash reserve from profit to deal with uncertainty and explore short-term financing options such as line of credit to strengthen liquidity. Second is end of inventory turnover. Aeon should implement just-in-time system to avoid overstocking, minimize holding costs, and maximize efficiency. The use of the data analysis to focus on high demand will ensure better inventory management and increase sales. So, for third is improve profit margin. Aeon should reconsider its pricing strategy to balance competitiveness and profitability. Reduction in operation costs can be achieved from energy efficient technology and outsourcing of non-core activity. Expansion into e-commerce will also provide new revenue streams. 4 is improve shareholder returns. Aeon's ROE of 0.06% is well below the industry average of 5.25%. Investment in high return projects, a share buyback policy and a continuous dividend policy are likely to attract more investors and increase shareholder confidence. So, for the last is technology to improve efficiency. Aeon can implement the latest financial and inventory management software to improve its operation and reduce costs. This will increase customer engagement and sales by engaging its e-commerce sites with features such as same-day delivery through digital marketing. Data analysis can be used by Aeon to take the right decision and optimize the resources. That's all for the task 3.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Afiq Akmal bin Kamal. My PDL is 2401022. Today I want to explain about conclusions. Aeon has done well in managing its debts, meaning it relies less on borrowing compared to the competitors. This makes the company financially stable and less risk. Additionally, Aeon makes good use of its shareholders' money, ensuring they get value from their investments. However, Aeon has a few weaknesses. The company struggles with liquidity, which means it has trouble paying its short-term debts. It also takes longer to sell its stock, which increase costs and affect cash flow. Lastly, Aeon profits are lower than competitors, meaning it isn't making the most out of its sales. To improve, Aeon should focus on 3 areas. Number 1, manage cash better. This includes collecting payments from customers faster, negotiating better payment terms with suppliers, and reducing unnecessary expenses to free up cash for short-term needs. Number 2, improve stock management by using better inventory systems. Ion can avoid overstocking and reduce holding costs. This will also help free up cash for other operations. Number 3, reduce costs and attract customers. Ion can put operational costs by using technology and automations. At the same time, marketing strategy like promotion and loyalty program can help bring in more customers and increase sales. Ion has a great opportunity to grow further. It can focus on improving its online shopping platform to capture the growing e-commerce market. Additionally, opening new store in busy, high demand area will help Ion reach more customers and increase its market share. By fixing its weakness and using its strength, Ion can improve its overall performance, remain competitive, and continue growing in the retail industry.